We had quite an interesting day for markets, and before we begin in this video, I want to show off this shirt. It is my Silicon Valley Bank Run t-shirt that I just received in the mail. So we'll talk about bank stuff in a moment because there was some Jamie Dimon talk on that. But nonetheless, let's talk about the market because for the first time in years, probably years, we got bad news being bad news. Now, this is normally the case. However, starting after the initial COVID drop, bad news became good news. Why was that the case? Because when we got bad news, it meant more government stimulus, more Fed cutting, more Fed stimulus, et cetera, et cetera, et cetera. It became stimulus. And that's how we got such an aggressive market rally, how, we had such a booming economy, whatever. Stimulus, stimulus, stimulus. Now we're in a different environment called quantitative tightening. And we've never been in this kind of quantitative tightening. We had a tremendously big balance sheet, which is going to be run off over the course of years. And today we got job openings data, available jobs out there in the labor market. And it was less jobs open than expected. However, still a lot more jobs than people looking for jobs. So by no means are we experiencing a cool labor market, and still by no means are we in a labor market that is more in balance with supply and demand. So, and it remains to be seen if this pace of decline is going to continue, because the economy is still strong. According to Jamie Dimon, Chase Bank, they're saying spending still above where it was this time last year, adjusted for all the important things like inflation, etc. So the economy is remaining strong as far as the data points to. Obviously, we have seen some Citi credit card data, but I'm also going with Jamie Dimon on this one. So, bad news is bad news. That's a good thing in my opinion. That is one step closer to being back to a market that is rationally priced and will move on rational things rather than the crazy market we've had, particularly year to date. But if you remember yesterday's video, we saw a very ahistoric and unusual event that I'm not sure has ever happened. The VIX being read 7 days in a row is something that happens about once a year. It's happened, I believe, 30 times in the last 34 years. The VIX being read 8 days in a row, which occurred yesterday, I'm not sure has ever happened. I don't know. It's possible it has occurred. I haven't confirmed that. It's pretty difficult to confirm that. The farther you go back into the VIX data, the farther it's going to be, and that's a whole lot of days to count. I could hire somebody in Malaysia or something to do that for me, but I haven't gotten around to doing that. Regardless, I know how math works. I know how once you add an additional event of already a unlikely event in a row, that it becomes exponentially more unlikely in most instances. So that's my assumption. I think based on that reasoning, I can come to that conclusion. It's entirely possible we have an outlier here and whatever. But I know 8 days in a row is going to be more unlikely than 7 days in a row. So very unlikely event that occurred yesterday. And then today, we get boom. Bad news is good news. And I think there's a whole nother leg to this market that's going to come down. And let's not forget, Mike Wilson was the most accurate market strategist of last year. He is, and one of the only ones who was truly accurate. And he's stuck to his guns so far this year. But his case at the beginning of the year was that there was a fire and an ice situation for the market. And this was the very beginning of the year, I believe December of 2021 or January 2022. He published this article, Fire and Ice, saying that the Fed was going to hike rates. That was going to be the ice side of things. That was going to, change the dynamic a little bit. And then there's going to be the fire side of the things, which was going to be the slowing economy. Today we got some slowing economy data. We know the Fed wants to see a slowdown in growth. Why? Because we stimulated so high. Think about it this way. The economy was on aggressive cocaine. You don't want to go into daycare tomorrow on aggressive cocaine. You don't. You want to be normal, balanced, healthy, and sober. So We want a sober economy because when we don't have a sober economy, we have inflation, and the people with money in their savings accounts buy up all the food, and they push the prices up, and they push the prices up for everything, and the prices just go up, and it hurts the people who don't have money. So inequality grows. We don't necessarily want inequality to grow because that makes situations worse. So we want to control this situation sooner rather than later. There's a lot of rich people on Twitter talking about how the Fed needs to cut rates because they've already done enough damage. They haven't done a lot of damage. There's way more job openings. They're talking about the damage in their portfolio holdings of highly speculative tech companies that don't make any money in many instances. Some do. But they're all expensive. They're all expensive. I mean, I'm short. This is my opinion, but this is all my opinion, obviously. But the people suffering the most from inflation are those least able to bear the burden of inflation. And the people who benefit the most from inflation, that benefit. There's some people inflation hurts, and there's some people who inflation benefits. People who inflation benefits are those most able to bear the burdens that inflation does bring because it doesn't affect them, basically. The people most able to bear the burdens of higher rates are those most, least affected by it and most affected by inflation, the lower income people. They're not buying expensive cars. They're not buying stocks even. They're not buying financial assets. They're not buying houses. It doesn't really affect them. Hopefully they don't lose a job, but if there's any time that we're gifted this perfect situation to fight inflation where we have so many jobs open that even if you do lose a job, you can very easily go get another one. And we're hurting all the employed people that actually are making an income. Their real incomes are going down. That's not good. We don't want that. So we are gifted the situation to fight inflation. This is what the Fed says. I'm not being speculative here. I'm not. I'm just kind of regurgitating what the people who have their hands on the levers of power are saying. And I'm going with that. I'm not going to fight those people. My opinion is you shouldn't either, but the market wants to fight them, and obviously we're all suffering here. I'm suffering big time. My clients are suffering. At least, they're all wealthy people, but at least when it comes to their portfolio that they have with me, it's not doing too hot. Not doing too hot. I'll give another update when we're at all-time highs again. I expect that to occur. I have been through worse situations. This is a bad situation, though. Definitely up there with some of the worst. Anyways, bad news is finally bad news. This is one step closer to the end. This is one step closer to a very rational, very logical, not highly, speculative, all over the place market. We want rational thinking, long-term growth. We want to get rich relatively slowly, but we're always willing to accelerate that process when we think we have an opportunity to do so. But we want to, at the end of the day, buy well-priced, cash-flowing businesses. And it helps when bad news is bad news and good news is good news to be able to do that. We want fundamentals to prevail, not stimulus, which I guess is fundamental, but it's crazy. So, it's crazy. Hopefully it's ending. And I expect the Fed to continue to tighten and continue to hike rates. One more, and there's a huge disparity between the Fed and the market. I don't know if you watched the Bullard video or watched yesterday's video over here, but Bullard said verbatim, he was asked, why do you think there's such a big difference between the Fed and Wall Street? He said, they should be listening to me. Okay? I don't know how more obvious it needs to be. And he did that in a completely different tone and way. He threw that in right there to be the most obvious thing. That was a direct address on Bloomberg TV to the market. You should be listening to me. I'm not trying to speculate. I'm not trying to do anything crazy. I'm trying to stick with the Fed. This, in my opinion, is the right way to go. You can fight them if you want. I'm not telling you what to do. The market is fighting them. I think it's the biggest dislocation I've ever seen. I think that presents us with a tremendous opportunity. Just one quick sip. And one more thing. Today, yields moved a lot in the jobs data. Obviously, we saw the stock market move a little bit, but I want to talk about what I expect to bring, one of the aspects to bring the next leg of the market lower. Obviously, slowdown, recession. That was made clear because more bad news is going to occur. More bad news is going to occur. We should expect that. We should expect earnings season to not be so good, even though estimates are quite high. Stock prices are near all-time highs. Many of them are. Many of the big ones. Susan Collins, I believe that's her first name, Federal Reserve President of Boston, I want to say, last week said weak jobs data would not influence her decision on the Fed. Today, interest rates went down on that jobs data. That doesn't make any sense. It went down based on the assumption that, now the Fed's going to cut. Well, they said they expect weak jobs data in March, or if there is weak jobs data in March, it's not going to affect their outlook. There you go. It's a missed move. It's going to correct at some point. I don't know when, but I'm assuming sooner rather than later. And that's today's video. So until next time, peace out.